We've discussed the basics of bond investing before with Doug Longo, one of our go-to fixed income experts. Doug, of course, is a vice president of Dimensional Fund Advisors and has written extensively about Dimensional's research into fixed income markets. Hi, Doug. Thanks for joining us today.
Thank you, Murray. Thanks for having me today.
In terms of bond funds and how fixed income markets work, can you explain a little more about the different types of bonds on the market today and the different sectors that investors can invest in?
Absolutely. So let's just break it down between the major sectors. First, you're going to start with governments or sovereign bonds issued by something like the U.S. Treasury, the United Kingdom, these large government entities. The less riskier bonds. From there, you'll have something that we call corporate bonds. So Microsoft, Apple, for example, they're corporations. They're looking to fund some kind of a project. They'll also issue bonds as well. And then the last really broad category is called securitized. So these are bonds that are generally backed by assets such as mortgages, auto loans, credit card debt, student loans. And the issuer issues those bonds, takes the proceeds, and lends it out for these different types of assets.
And the more risk involved, the higher the interest rate the bond issuer is going to give to the investor. But the investor needs to realize there is more risk involved.
That's right. So bonds, they have credit ratings. That issuer has their own rating, just like as individuals, we have credit scores. And the riskier that issuer is, the investors in bonds are going to demand higher compensation for taking that risk. So it's a way of saying you may have a lot more credit risk, or your ability to repay your debts may be lower relative to a government. And as a result, I'm going to require from you a higher interest rate for me to take that additional risk in my portfolio.
How do Dimensional's portfolio managers manage that risk in terms of looking out over the yield curve?
So we do a couple of different things. For one, there are large agencies out there called S&P and Moody's. They go through the individual issuers themselves and give them credit ratings. Just like, again, we get as individuals, you get an Experian credit score. So they do the same thing, but for bond issuers. So we'll start there with what's the rating from the big agencies like S&P and Moody's. And then in addition to that, at Dimensional, we give every bond our own credit rating. And we look to see where are bonds trading in the market and what's the yield on that bond relative to a peer of that issuer. And if one of those two issuers is trading with a yield that's much higher, or an interest rate that's much higher than its peers, that's an indication that that particular issuer has a lot more risk in it. So to get a Dimensional credit rating that's much more lower or riskier, and we may avoid that bond in our portfolio because of that.
Okay. And your portfolio selection process is flexible on the trading end, correct?
Absolutely. We want to make sure that we don't have to go out and be forced to buy any particular bond. We also don't want to make sure we're not forced to sell any particular bond. So what we do in the portfolios is we diversify them across characteristics. Some of those characteristics could be different issuers, different credit qualities, different countries, different currencies, different revenue sectors, so that we make sure we have lots of different candidates in portfolios. And when we have to trade, we can trade many candidates and not be forced to move certain bonds at certain times during the day.
And I guess trades and bonds can be made overseas using local currencies versus the US dollar. Do you folks have a preference that way?
We absolutely, we can buy bonds in multiple currencies. So I could buy a US dollar denominated bond, a euro, an Australian dollar. By having multiple currencies, what we find is those currencies don't move in lockstep with each other. So if the US yields increase, they may decrease somewhere globally. So a larger opportunity set can reduce some volatility. Also, you may find that somewhere globally might have higher interest rates relative to the US. So having the ability to look globally and be opportunistic can also improve the expected return of a portfolio. So we do want to invest in some non-US dollar denominated bonds, but one of the things we do to reduce currency risk is we hedge a lot of those currencies back to the US dollar so that we're not really worried about those currencies appreciating or depreciating relative to the dollar. It's really the interest rates that we're trying to focus on in portfolios.
Sure. And I guess that's especially important in times when there's inverted yield curves or even if the curves are flattening.
Absolutely. There could be an instance, and I'm thinking back to 2017, 2018, where the US yield curve was inverted in the short-term segment, but the euro yield curve was steep. So in a portfolio, we may want to sell US dollar denominated bonds and buy euro denominated bonds and get those higher expected returns in that market. So anytime you have a global opportunity set, you have the ability to add value over just a domestic or local only portfolio.
I guess that's true too with corporate bonds in that you can pick sectors, financials, industrials, consumer goods, products.
Absolutely. What we do in the portfolios is we compare corporate bonds relative to government bonds. And if it makes sense to get that additional interest in those corporate bonds for the additional risk in portfolios, we'll do that. When we think it doesn't make sense, there's not enough interest to take that risk in portfolios, we'll focus more on government bonds. So you really want to be dynamic in terms of moving across those different asset classes within fixed income based on what we call risk adjusted returns.
Okay. Doug, thank you very much for your time today.
My pleasure. Thanks so much.